Hi, Michael Oleary again from Buy the Book Taxes with my third video in a series that I've done on the IRS Offer and Compromise program, in which taxpayers may qualify to pay off their tax debts at less than 100 cents on the dollar based upon a formula called reasonable collection potential, which the IRS uses to determine the taxpayer's ability to pay. Don't believe those TV commercials with the 800 numbers telling you pennies on the dollar. That's not how it works. I'm going to show you how it works because I know how to do it. The last video I did showed someone who was a full pay client who did not qualify for an offer and compromise. In this video, I'm going to show you a client who does qualify to pay at less than 100 cents on the dollar. I'm just going to share my screen. I have this in a spreadsheet and I'll walk you through it. Same example, same numbers. Tax client owes $175,000 for a tax year 2017. Tax return was filed on April 1st of 2019. The IRS has 10 years from the time the tax is assessed, which is generally right around the time the tax return is filed, to collect the debt. That 10-year period, or the end of that 10-year period, is called the CSED, the Collection Statute Expiration Date. The IRS actually has 10 years to legally collect the debt. For this year, since it was filed in April 1st of 2019, and I am recording this video the first week of January 2022, there's a little over 7 years in total, 87 months left on the 10-year statute for the IRS to collect. We're going to come back to this number later. It's a very important number. So as I mentioned in the earlier videos, the IRS looks at this in two pieces. They look at the taxpayers' assets and debts. That's the first piece. And the second piece is their income and their living expenses. And then they put them together at the end to determine their ability to pay. And they call that figure, which represents their ability to pay, reasonable collection potential. Because what it means is, how much can the IRS reasonably collect from this taxpayer without creating a hardship in their living circumstances. So let's look at the assets. Excuse me. So this taxpayer has a little over $3,200 in the bank, a retirement account of almost $43,000, cash value life insurance of $3,500, and a vehicle with a Kelly Blue Book value of $15,000. The IRS has a concept, I'm going to take a drink here, called quick sale value, which means if you had to liquidate all your assets in a short period of time in order to raise cash to pay down IRS debt, you're probably not going to get 100 cents on the dollar. You'd probably have to sell your assets at some sort of discount. The IRS takes that into account when calculating the value of your assets that can be used for the calculation of your ability to pay. Quick sale value. For cash, there is no discount. Cash is cash, 100 cents on the dollar. Same is true with the cash value life insurance if you can get at it. A retirement account is different. Think of this. If you took money out of your retirement account, you'd have to have federal income tax, state income tax withheld. And if you're under 59 and a half, you might even have an early withdrawal penalty. So taking that into account, if you withdrew $43,000 from a retirement account, you're probably ending up with only about $28,000 net. Then the vehicle, you have the $15,000 asset value. The quick sale value is 80% of the fair market value. So you deduct 20%, you take a 20% haircut off the 15,000, you take 3,000 off, you end up with 12,000. So on a little less than 65,000 of gross asset value, this taxpayer has a little bit under $47,000 of quick sale value. In addition, you make another deduction for any loans that are outstanding against any of these assets. In this case, there is a car loan against a vehicle of $47,668. So you deduct that. So the net asset value for the vehicle is $7,200. In total, you have 65,000 of gross assets, less 47,000 of quick sale. Reduced to quick sale value of 47,000, less a $4,768 car loan. So you have net equity and assets of almost $42,000 for this taxpayer. There are two more deductions you're allowed. You can deduct either $1,000 or potentially 1 month of living expenses from the cash value, but you cannot deduct more than the cash value in order to make that a negative number and bring that number even further down. So in this example, the taxpayer actually has about $10,000 per month of living expenses. You can't subtract 10 from the 3 and make it -7, but you can zero out the $3,200 of cash. Okay, and then you stop there. In addition, there's an additional deduction of about $3,650 that can be taken against the net asset value of the vehicle. So we're doing that here. We're taking an additional deduction for the living expenses to zero out the cash and a further reduction on the asset value of the vehicle. We end up with net equity and assets of $35,000. Now we're going to go look at the income side of it. And the income side is called future income analysis, which looks at gross monthly income, allowable living expenses to get to a net number, which the IRS will look to and say, okay, how much cash do you have left over each month after covering your living expenses in order to pay us? So here we are. So this client has $11,000 per month of net business income. In other words, after his business expenses, he's left with $11,000 to put toward his living expenses. He's a single parent, 3 children, living in Fairfield County, Connecticut, where I live. Household of 4 people. Now, here's another concept which is important. The IRS has called allowable living expenses. You don't get to deduct 100 cents on the dollar for all the expenses you spend in your household in a given month. For example, not in this case, but if you have a second or third vacation home, you can't deduct all those expenses. If you have multiple children in private school, you can't deduct all those expenses. If you are paying cosmetic surgery for your second, third, or fourth wife, you cannot deduct those. So how does the IRS determine what are allowable living expenses for these 13 different categories that basically cover food, clothing, and shelter, vehicle operation, other transportation, health insurance, medical costs, court-ordered payments like alimony, child support, daycare, life insurance, current year taxes, secured debts like student loans, home equity line of credit, and also in case you owe delinquent taxes to the state. So here's how the IRS does it. They gather information, cost of living information. I'm sure you've heard the expression, the cost of living index, which kind of tracks inflation. The IRS captures data from the US Census Bureau, as well as the Department of Labor, Bureau of Labor Statistics. And they have calculated basically the cost of living for all these different categories on both a national level and also down to the regional or even local county level for these expenses. So depending on which expense category we're dealing with, the IRS allows you to take some combination of the national standard, the local standard, or your actual expenses based on your family size and where you live. So for example, I mentioned that our taxpayer lived in Fairfield County, and it's a household of 4 people, an adult and 3 children. So that all gets factored in determining what the allowable living expenses are. So let's put it together. Okay, as I said, household of 4, Fairfield County, Connecticut, $11,000 of monthly net income. So here's kind of the matrix of the actual expenses, the standards, and the allowable. So food, clothing, and miscellaneous, national standard, household of 4, Fairfield County, $1,740. Housing and utilities, the national standard, it's just, doesn't matter what county you're in. Housing and utilities, it's the local county standard for a family of 4 in Fairfield County. So the actual that this taxpayer spends is $37.28, but he has to take the local standard. Same thing with vehicle ownership. It's a national standard for the vehicle ownership. It's a local standard for the vehicle operating, public transportation, national standard, actual for health insurance, actual for, actually this is the standard for out of pocket. Court ordered payments, alimony, that's an actual, he pays that. Life insurance, current year taxes are an actual. So he has $10,665 of allowable living expenses per month to go against $11,000 of monthly income. So the IRS, there's only $335 left to pay the IRS each month. So let's put this all together and figure out, is this taxpayer qualify for full pay, or will the IRS settle for less than 100%? So we take the net equity and assets, $35,000. Then we look at the $335 a month that's left over to pay each month and multiply it by 87 months. Remember that number, 87 months. That's how long the IRS has to legally collect this debt until the collection statute expiration date. So you multiply 335 times 87 months, you get 29,000. Add the assets to the future income, you get $64,000. That's the RCP. Is it more or less than what's owed? It's less than what's owed. So the IRS will accept less than $175,000 on this offer and compromise. So the next question is, what do we offer? You don't offer the RCP. You can offer less. There's 2 types of offers and compromise. what they call a short-term lump sum. You could pay off the balance in 5 months, or what they call a deferred offer. You could pay it off over 24 months. So the way this works is, for the lump sum that you pay off in 5 months, you take the net equity and assets and multiply it. You take 12 months of what's left over, the free cash for 12 months. And that's your offer. So that would be a total of $39,020, $35,000 of which is based on the assets, and $4,020 is based on the income. However, if you wanted to pay it off, space it out over 24 months, the number's a little higher, because you have to calculate, it's the $35,000 in assets again, plus 24 months of the $335. So it's a little higher. In this case, I would go with the $39,000 and pay it off in 5 months. The reason I mention that is, the longer you have, the longer the payoff period is, the better chance it is for the taxpayer to default. In other words, miss a payment. And if they miss a payment, they default on the offer in compromise, and the IRS can reinstate the tax. So my preference is always the short-term lump sum amount, which you would pay off in I think it's not more than 5 months. Okay, it has to be paid off within 5 months of acceptance. So that's how it works. I'm going to stop sharing my screen, and I'm going to share one other screen here. So here's my contact information: Michael Oleary, Norwalk, Connecticut. Cell, fax, email, website. Here are the services I provide: tax preparation and tax resolution, 1040 and 1041 estate and trust preparation. And here are the resolution options: installment payment agreements, offer in compromise, currently not collectible, innocent spouse, penalty abatement if possible, liens and levies if you're dealing with them, trying to refinance a mortgage, sell a house. I offer CPA quality without CPA prices. Also, if you have a business and you have delinquent payroll taxes, please call me. I can help. If you have years of unfiled tax returns, owe the IRS significant amounts of money, are getting threatening letters from the IRS, threatening liens and levies, please call me. I can help, and I'll see you in my next video.